Hello, chart watchers, and welcome to Market Watchers Live with Aaron Swinlin and Tom Bowley. I'm your host, Tom Bowley. Today's show is being recorded, so you should be able to play back any or all of Market Watchers Live at your leisure. If you're unable to attend the show live, you can now go to www.stockcharts.com/webinars. Follow the link to Market Watchers Live and play back the show. Each show will be archived on our site until the next show begins, so you'll have roughly 24 hours. If you'd like to review an older program, you can now find those at our YouTube channel or on Facebook. During today's show, please feel free to submit your ticker symbol requests, questions, and comments using the chat window next to the video player. Later in today's show, Aaron will provide me stock symbols from your questions, and I'll use those requests in the 10 in 10 segment at 12:50 Eastern Standard Time, where I'll attempt to annotate 10 stocks in 10 minutes. Market Watchers Live now airs 5 days a week, Mondays through Fridays from noon to 1:30 p.m. Eastern Standard Time. If you'd like to be part of the show, you can now reach us via our chat room or Twitter. Our Twitter handle is at Market Watchers Live. That's at MKT Watchers Live. As you leave today's show, we'd love to get your feedback. In the lower right portion of your screen, you'll see a How'd We Do section with a link to a very brief survey. Let us know what you think. And also give us some suggestions for future shows. We'd love to hear your thoughts. For those of you joining us for the first time today, welcome to the show. We are glad that you're with us here on this Friday. And for our regular folks, welcome back. Got a couple of announcements to make before we get into the show. First, tomorrow, Chart Watchers, the first Chart Watchers for December will be out. If you're not already a subscriber to Chart Watchers, that would be one of the first things I do. All you have to do is click on the blogs at the top of the page and then scroll down on the right-hand side, and you'll find an area where you can subscribe to Chart Watchers. It's free. You just simply type in your email address, hit subscribe, and that newsletter will be sent to your email, and it is regularly sent out the first and third weekends of each month. So it's going to be really interesting with everything going on and all the transition that we've seen and their sector rotation, what everyone's thoughts are this weekend. So make sure you are subscribed to Chart Watchers for that. Next Wednesday, Tushar Shande will be joining us, and he will be giving us a little bit of analysis and talking to us about his trend meter. A lot of really good stuff. So make sure you have that marked on your calendar. And next Friday, Aaron will continue our regular educational portion of the show, and she will be discussing the DP trend models next Friday. So make sure you have your calendar marked for that as well. And with that, I'll bring in my host, Aaron. How are you doing this Friday?
I'm doing quite well. It is Friday after all, so get ready for a fun weekend. Got a lot of sports to watch today, though. I'm kind of having a dilemma because the Ducks are on tonight, but they're on at the same time that the USC Stanford Pac-12 championship game is on. And of course, for those of you who know or don't know, I am a USC Trojan, so I'm pretty excited about it, but I think I'm going to choose football tonight and record the Ducks game.
Yeah, I'm in mourning.
Oh, I know. I feel so bad for your Redskins.
Yeah, they're done. They're done. Stick a fork in them. So now I'm moving on to college basketball and hockey. That's about what happens this time of year for me. The players go golf and I get to watch college basketball.
That's right.
Anyhow, for what that's worth. I know we got a busy lineup for everyone today, so I'm going to let you get into the agenda and then give us that first market update.
All right, sounds like a plan. And yes, we will be doing market updates at 12:05 right after we finish this agenda, and at 1 o'clock. Talking technically, we're going to start by looking at just some of the recent economic reports, talk about a little bit about what's going on in the market today for sure. Tom's workshop is going to be after that, and it is all about trading strategies using the MACD. So I'm sure you're going to love that and want to watch that in our archives on our Facebook page or YouTube channel. 10 and 10 to 1. Our first one will be Tenant Healthcare, THC. This arrived to us via email. And so you can take your notes, and Tom will start with this one in the 10 and 10 to 1, where he takes 10 symbols and attempts to annotate them in 10 minutes. Sentiment, I'm going to go over what's going on with the sentiment update. I'm seeing some pretty interesting stuff right now. So I'm really looking forward to talking to you about that. And then Tom and I are going to take our Wall Street sentiment poll and let you know whether we think the market will be ending next week higher or lower. And I will put up a Twitter poll for that as well. Mailbag and wrap up to finish us off. And with that, we will move right along into our first market update. And indeed, it has been a very interesting morning, to say the least. Everything was going pretty normal, I would say. The first part of the day, as you can see, the Dow did move down a bit, but it was back into positive territory. Political news hit the wire, and all of a sudden we saw some serious declines. But I am encouraged because we are seeing it come out of those intraday lows. It's just dug a little hole for everybody to try and dig out of before the end of the day. S&P 500, same thing. NASDAQ, that's been suffering, but it actually started the morning not doing that badly in comparison to the others. But it did get hit hard also after the news events. And now we're seeing the NASDAQ coming back to life, as well as the Russell 2000, Wilshire 5000. Treasury yields took a dive after the news, but it looks like they're beginning to make a move back up, just like the markets. But reading right now at 23.67. UUP, the dollars had quite a roller coaster day. Started up looking pretty good, and then again the news hit. Everything pretty much fell quite a bit, except for gold and the VIX. Of course, the VIX measures. A lot of times we say that it measures sentiment, how people are feeling about the market. So when all the news came in and everything was dropping like a rock, not surprising to see the VIX make a move. And look at gold, it made quite a move. But again, both of those are pulling back. GLD is heading back down, currently reading at 121.60. Declines are currently leading advances. I'll take a quick look at our market summary, let you know which industry group sectors are doing the best, and a quick peek at our overseas ETFs, the international ETFs. So just to start looking at the major indexes, S&P 100 is faring the best, but it's still down, 0.43%, and hopefully climbing. S&P 600 small caps are getting hit the hardest right now. As far as our sector spiders, energy is in the lead, up almost 1% right now. I did get some negative signals on energy yesterday, so turned out to not be as much of a problem as it looked. Technology and industrials are the laggards. And looking at industries, oil services, gas, commodities, gold near the top. Not a surprise again with the difficult morning and current afternoon we're having. Disk drives, hardware semis, all technology industry groups are the laggards right now, down over 2%. And we can see as far as international ETFs, Canada, Brazil leading the way. Canada's ETF, EWC, is up over 1.5% right now. So having a nice day there for the Canadian ETF. And the laggards right now, India is down over 2%, INP. RSX, the Russian ETF, the Russia ETF, is down 1.34%. So it is getting hurt as well. Kind of interesting given the news that we're getting right now about Michael Flynn and Russia. So interesting how the markets really were affected by this. And that's all I have for the first market update.
All right, sounds good. Got a little bit of economic news that I'll go through here. And while I'm doing that, I'll show you the 10-year Treasury yield. It has been a wild day in the bond market with the yields going all over the place. And in my blog this morning, this was my biggest concern actually coming into the market today, because yields have been rising. And so, we've got different areas of the market that have really taken their cue from the rising yield, which means probably that the bond market is expecting some strengthening economic conditions ahead. So with the huge move up in the XLF and the XLI and transports and retail and all these different areas, if the yield were to reverse even temporarily back to the downside, it would create what I felt was some profit taking in those areas. And we saw some of that this morning. And of course, the technology group, I feel like, is already, in the short term anyway, in some technical trouble. So, the yield dropping, I think, really squelched at least temporarily, the rally that we had going in some of those key areas that I talked about, the transports, financials, including the banks and life insurance, and some of the other areas, retail and so forth. So that is kind of what's going on. And when you look at this 10-year Treasury yield, I mean, literally the high today was 242, the low was 231. That's a pretty wide range. And if you go back and look, that's one of the widest ranges that we have seen as we go back. I mean, I don't think I've seen anything this wide. I'm still looking back. It might be the widest swing all year long in one day. So there's a lot of indecision taking place in the Treasury market. And I think that's, just making everyone a little bit more nervous in the stock market. And that's why we're seeing these big swings. The good news, though, like Aaron pointed out, is that we have bounced off some of those lows. So I think that is a positive. As far as the economic news that came out today, we had November PMI manufacturing 53.9. The market was looking for 54.5, so a little bit of a miss there. November ISM manufacturing 58.2 versus the 58.4 that was expected, so a slight miss there. But October construction spending was up 1.4%, and the market was only expecting 0.5%. And I think that construction spending number may have been, well, it wasn't the highest, but it's probably in the top 5 readings that we've had in the last 4 or 5 years. I mean, that was a big number that came in. So we kind of got mixed signals there in terms of the economic reports this morning. And then, of course, as Aaron was mentioning, the political uncertainties and everything there, probably adding to this. Although I'll say I follow what's going on in the charts. I really think all that stuff is noise. News is noise. And so I like to see the price action. And on this chart here, you can see, and actually I think I have a annotated chart on the TNX. If I get the right chart list up. Yeah, on the TNX, you can see right here, here was the triangle. And I thought this was very bullish, an uptrend followed by a symmetrical triangle. And then we saw the breakout the last 2 days. Look at this move down. It looked like temporarily we might be losing this triangle breakout, but now we've come back up and currently we're sitting at 236, which is above that. I'd be concerned if we were to take out about 230 to the downside. I think that would be a real false breakout. And I think that could trigger some selling. And you could see how quickly the S&P 500 was selling off earlier today when that yield was dropping. The S&P 500 went all the way back down almost to its rising 20-day moving average before reversing. So we were down to 2605, which was 24 points lower than where we are now. So at the low, we were probably down about 42 points on the S&P 500. That's some serious selling. And so that's why I think we need to watch the Treasury market today, and let's see what happens with that yield, which direction we head. A couple of interesting charts today, industry group wise. First, the banks. Anytime we're talking about craziness in the bond market, we want to look at the banks. We had a nice breakout. Unfortunately, look at that black candle off of this uptrend. That normally, well, most of the time that will suggest a short-term pullback. That I'm not looking at a black candle as being the signal of a bear market. In fact, I think this is a very bullish move to the upside. But when you gap up, move higher, and then come back down and close near the low of the day after an uptrend, a lot of times that signals a short-term top. And you can see today we went back and tested the area of the breakout, but we're bouncing off of it. So I do find the action since that low to be pretty bullish. We'll have to see whether or not that continues. And again, this is going to be based a lot on what happens in the bond market. Housing, home construction. Pull up this index, DJUSHB. And you can see also weakness earlier today. We got down as low as 919, but we are back to 934. I think some of this is everyone focusing on the construction spending number, which was just, knocked out of the ballpark. And check out this MACD. I'm going to be going through discussion on the MACD, but you can see that it continues to accelerate to the upside. So normally when you see that, pullbacks are bought. And that's exactly what we had today. A couple other areas that I thought were interesting. Defense stocks. If you were watching or looking at the sector performance, as Aaron went through it, industrial is really having a little bit of a problem today. And defense stocks are a big part of that. Group is down 1.72%. But notice after printing Well, technically, it's not a negative divergence because we didn't have a higher close. You can certainly see that the MACD had rolled over and we consolidated for a while, had a little downtrend. You could call it a wedge, a flag off of this uptrend, whatever you want, but it went down to the 50-day moving average and then started bouncing up. We're starting to see accelerating momentum. When that happens, I like that rising 20-day moving average. And even though we went below it intraday, we're trying to hold it right now, which I think is a good thing. And then the last industry group that I wanted to mention was the semiconductors. This group is really under a lot of pressure. It is not surprising at all. It was incredibly overbought. We had a parabolic move to the upside, negative divergence on the most recent high, failure to hold the breakout. The 50-day moving average, in my opinion, was the initial move to the downside. That is kind of like a minimum that I would be looking for. I don't know. I think if you connect the trend line, we could see some more weakness in semiconductors and a move below that 50-day moving average. And I think if we look at the weekly chart, and I'm going to talk about this also with the MACD, the weekly 20-week moving average, which has been holding for a year and a half, that is down right now at 3,030. So when you go back to that daily chart, you can see 3,030 is all the way down in here, maybe toward these tails. So don't be shocked if the semiconductors lose 50-day moving average support and really put a scare in a lot of those who have been, jumping in maybe toward the highs. Unfortunately, that's just the way the market works. We saw it with the financials. We saw it with the industrials. We saw it with materials. They broke out negative divergence, and then the floor kind of fell out from under them. And now it looks like it is semiconductors taking their turn. And if we pull up the XLK, which is the technology ETF, you'll see the same thing here. Higher prices, lower MACD. We haven't even gotten down to the 50-day, but I will not be surprised if we get there, possibly even a little bit lower. I think in this case, maybe the trend line comes in around 60, 61, and we've got some gap support around 61. So that might be a target down the road that I would be looking for, but I would be really careful with the technology group here in the near term, just based on the way it's trading, some of its key groups, components, the way they're trading, I think could be a problem. So with that, I'm going to go ahead and switch over now, and I want to talk to you a little bit about the MACD and how I use the MACD. I'll start off with a little bit of a maybe a explanation of the MACD and the PPO. I'm going to concentrate most of this discussion about the MACD, though, not the PPO. I just want you to be able to distinguish the difference between the two of them. So let me go ahead and pull up my first chart. And the first chart is Google. And what I've done here is, first of all, you'll notice this chart's not set up the way I normally have my chart set up. I set this up specifically designed to show you the MACD. Now, the MACD, the default, and for those of you who are wondering, about the MACD, I'm not talking about McDonald's latest sandwich. I'm talking about the moving average convergence divergence. That's what it stands for, MACD. Moving average convergence divergence. So we're taking two moving averages and we're plotting it on a chart showing the convergence and the divergence. So here, when you see a MACD moving higher like this on Google, it means that the moving averages are diverging. So they're moving further apart. When you see it start moving back toward the center line, that means that they are converging. And if they go below the center line and start accelerating to the downside, now they're diverging again. So anytime you're at the center line, there is no momentum in either direction. Your two moving averages are exactly the same. So the default setting on the MACD is 12-26-9. And you see that when you go down to the bottom. Well, actually, when you have the MACD in here and you look at the parameter, if you don't change it, the parameter comes up 12-26-9. And what that means is that your MACD, your moving average that you're looking at, the two moving averages, is the 12 period and the 26 period. So that's where you get this 12-26. The 9, and I'll talk about this a little bit later, but that's just a 9-day moving average of the MACD. But again, I'll talk about that in a little bit. So let's talk about this MACD and how it's calculated. What I did is when I set this chart up, I set up overlays, exponential moving average 12-day, exponential moving average 26-day. Now, these are not going to be exact because price action has changed since I annotated this chart. But the idea is that the difference between these two moving average, which when I did it was 8.11, and you also would have seen 8.11 there. Now it is 7.14 up here on the MACD. That's the actual difference between the two moving averages, 7.14. And if you take a look at the moving averages that are here right now, you've got the 26-day moving average at 1,035.94, and you've got the 12-day moving average at 1,043.08. The difference between those is 7.14. So if I updated this right now, I would change that 8.11 to 7.14, and you can see there's your 7.14, and here is the reading on the MACD, which comes in, you can't really tell, but that's what it is. It's at 7.14. Okay, so that's all the MACD is. It's the difference between two moving averages. You can set the moving averages to be whatever you want them to be. I use the 1226 because as a technical trader, I want to know, or I want to have a feeling of what to expect from other traders based on what's happening with the MACD. I almost always use default settings because that's the setting that most traders will use. And if I'm using a setting that no one else uses, it's going to be really hard for me to anticipate what they're going to do because they're not using the same indicators. So that's why I like to use the default settings. But that's the MACD. So what's the difference between the PPO? Because if you look at these, they look almost the same. I mean, every movement looks identical. So what's the difference? Well, the difference is pointed out in red. And what you're doing with the PPO is that you're calculating a percentage. So instead of looking at the dollar difference, what we're looking at is the percentage difference. So the PPO equals the percentage difference, or in this case, it would be 7.14 divided by 1,035.94. You have to ignore some of these numbers I put in because, again, when I annotated this, all the numbers were different and everything is kind of changed here. But if you look at it, 7.14 divided by 1,035.94 would give you this percent right here, which is 0.689%. So that would be the number that we'd be going in here. And that's the reading that you see over on this between 0.5 and 1.0. All right, so that's the basics. It's very simple. The MACD is not some magic potion. It's not just this number that points one way or the other. It's a mathematical formula. And every time price changes, the MACD will change. And so what this thick black line is doing is it is simply tracking this calculation between the two exponential moving averages, in this case, the 12-day and 26-day moving average. The PPO is calculating it based on percentage difference. MACD dollar difference, PPO percentage difference. That's all. That's why you look at them and they look almost the same. So why have the PPO then? If they look the same, why would we need the PPO or why do we need the MACD? Well, that's a good question because I think probably, and I guess for me, because I've been using the MACD for so long, I haven't made the switch. But the PPO to me is truly the better indicator. And the reason I say that is there's one key difference between the two. The PPO you can use to compare momentum from one stock to another stock, even though the price of those two stocks could be crazy different. Let me give you an example. So Google here has a MACD of 7.14 right now, which is the difference between its two moving averages, $7.14. But its PPO is less than 1%. That, because it's such a big dollar, such a high price stock, if you just use the MACD, chances are you're going to get a pretty big number because the price of the stock is so high. Chances are there's going to be a pretty significant difference between your moving averages. The PPO, however, is based on the percentage. So it could be a real high dollar amount, but it could still be a very low percentage. If I pull up the next chart here, I want you to compare this to GAP, GPS. Now, GPS, you can see, and again, your MACD and PPO look very similar. But notice that the MACD, while it's only 1.28, and if we go back to Google's is 7.14. So if you're looking at MACD readings, you might come up with the wrong thought process. And you might say, well, Google has more momentum because its MACD is higher. But you got to remember it's based on a higher price. The way you really want to determine the momentum is by looking at the PPO. And here you can see Google's PPO is 0.689. And when I go up to the gap, it's it's over 4%. And one look at the chart, common sense, look at gap. I mean, look at this move to the upside. I mean, it's got tremendous momentum to the upside. And that's why you have such a high percentage on the PPO. If you go back to Google, Google's been going down for 4 days. So again, if you compare their MACDs, it could give you a completely different outlook on the two companies in terms of their momentum. But if you use the PPO, it'll give you the better performing stock on a momentum basis. And in this case, it's Gap, which has a much higher percentage to the upside. So just wanted to point those two out before we go any further. So let's take a look at the next thought here on the MACD. So we know what the black line is. And of course, we compared it to the PPO. So we got a good idea there. What's this blue line? And what are these bars here? Well, the blue line is considered the trigger line for the MACD. And that is simply the 9-day moving average of the MACD. So you're going to always see a lag. When the MACD turns down sharply, the blue line will turn down with it, but it'll turn down slower. So it kind of smooths out the MACD a little bit. There are a lot of traders that use the trigger line crossovers. I do not. I find that they are very misleading for me in my short-term trading. Rarely do they give me the signal that I'm looking for. Now, you might look at Amgen here in this example and see the MACD crossed over, and wow, look at this move to the downside. You know, it certainly worked in this case. And there are other times, look at this move here. We got a nice crossover from underneath, and we had a huge move to the upside. So I'm not saying it won't work. It just won't work consistently in my trading strategy, which I'll go over in just a bit. But here you can see a crossover. Just as we're making this one little bounce, we get a crossover, and then it goes down further. And then before you know it, this rolls back over at the low. Well, that's the bottom and starts to turn back up again, and then you don't get that signal for a while. So you get a lot of whipsaw if you're not careful with the MACD crossovers. But that blue line is the 9-day moving average. So what are these big green bars? What does this mean? Well, this going across here is the MACD histogram. And what these bars are measuring is the distance between the black line and the blue line. So it's the distance between the MACD and its 9-day moving average. So if you're ever wondering, are you getting a crossover? One look at the histogram will tell you. If the bars go positive, go above the center line, then you can tell that this is just making a crossover. If it's still below and you're looking at it, you can't tell, well, I don't know if that's a crossover or not. Look at the histogram. Now, there are many who will use the histogram to provide positive divergences before you actually see it on the MACD. And I'll talk about positive and negative divergences in a bit. Here you can see the MACD histogram was turning back up. See how the bars are getting smaller, but the price keeps getting lower? According to those that follow the MACD histogram, that's a positive divergence. Because as prices keep going down, the distance between the MACD and its 9-day moving average is squeezing lower. So that's a positive divergence. Now, in this case, I don't really think it gave you a very good signal. I have just never really been able to perfect a trading strategy using the histogram. Some do, and I think it's great. If it works, I'd stick with it, but it's just something that really hasn't really worked for me. All right, I think that's it for this chart, so let's move on. Okay, very basic. When the MACD is above its center line, it's telling you that its short-term moving average is above its longer-term moving average. That's the calculation. So this black line, as you can see, basically trading up above the center line. This is telling you that throughout this entire period, the short-term moving average is above its longer-term moving average. And to me, that is generally bullish for a stock. Now, you can have pullbacks. You can see pullbacks, and you can see that the MACD comes down when you get a pullback. It's a mathematical formula. So when prices start moving lower, you're going to see the MACD move lower. It's going to happen. But for me, the MACD is a secondary indicator. It's not my primary indicator. So just because this line is pointing a certain way, or just because this line is making a crossover below the trigger line or above the trigger line or the center line, that is not going to make me trade a stock. I use this as a secondary indicator. For me, it's all about price and volume. And I use this as a secondary to kind of confirm what I see on the price chart. So here you can see for a period of time, this is the Dow Jones US Restaurants and Bar Index. Earlier in 2017, very nice momentum to the upside, evidenced by that MACD above zero. But then we went into this little tailspin for a while, and look at the MACD go below the center line. So it's telling us that based on this daily chart, we had some slowing momentum. And then we moved back up, crossed over, and now we're trending higher. And you can see the MACD back in positive territory above zero. So this zero right here, this center line, to me is pretty important, because at the center line, you have no momentum in a stock based on the two moving averages that you're using. When that hits zero, then what it's telling you is that your two moving averages, in this case, the 12-day and 26-day EMA, they are exactly the same. So as far as I'm concerned, there's no more evaluation of momentum to be had. You have none. And so I call that a reset. And anytime it goes to zero, and let's say here we had started to move up again and we got a breakout in price, I would not look back and call that a negative divergence as we moved higher, but our MACD was lower. And the reason being is that momentum resolves itself. And then it's almost, I always use the analogy of a baseball game where you have a 3-game series. One team wins the first game 10-0. You don't start the next day at 10-0. You go back and you play 0-0 again. You have a new game. And for me, when that MACD hits the zero line, I don't care about any of this before. Now I'm at zero. I'm reset. Which way am I going? Am I going to turn back up? Am I beginning to accelerate again to the upside? Or am I accelerating to the downside? In this case, we broke down and continued moving lower for a while. Now, notice here as we came up, and this might help to explain a little bit of my strategy in terms of putting price and volume first. Here, look at this breakout. We went above the 20-day moving average. We went above the 50-day moving average. And look at this bullish MACD crossover here above the center line. I should just jump in and buy, right? Well, except that we have this really solid price resistance level right here that we had gapped down beneath back at the end of July on massive volume. And on separate occasions, we've come up and we have not been able to get through that level. So here, the MACD is telling me to go, buy. I'm above the center line, bullish momentum kicking in. Here, it's telling me I've crossed over the moving averages. It's a buy, but this simple price analysis tells me I haven't gotten through resistance. And this is the most critical call for me. Can I take out key price resistance? In this case, I did not. And look at this. We end up going back down one more time. False signal. So that you want to be careful of. Now, if we go further, one of my strategies is when momentum starts to strengthen. Here we get the breakout. So all of a sudden now I've got the MACD moving up. I've got a price breakout. And on the first pullback, I print a hammer after testing support. I test a hammer at the 20-day, or I print a hammer testing the 20-day moving average. I love that. That is like nirvana for me because I'm able to manage my risk. So I've got this move to the upside. I don't like to chase. I get overbought. But notice on the pullback, I actually moved back down on the RSI closer to 50. I print a hammer, which tells me that I'm looking at a potential reversal. That comes off of price support and the 20-day moving average. And that is where I would want to enter. And then it goes higher. Now, I put this red arrow in here because, again, remember the MACD is a little bit of a lagging indicator. It's calculating your last 12 and 26 days, and you're plotting the difference between those two. So here, look at this little crossover. This is a bearish crossover of the trigger line. Some look at that and say I'd sell, and yet everything on this chart's telling me to buy. And then we move up on the restaurants, pull back again, and look at these two blue arrows. As we put in a new high here, that tells me that when we pull back, we should look for continuing support at that rising 20-day, which we do. And then here, as we make this breakout, notice, first of all, the volume picking up. That's always important to me. And even back in here, as we moved higher, you can see that there was some heavy volume coming in. that is further confirmation of some very bullish momentum, because it's a sign of accumulation. You can't have financial companies, the Goldman Sachs of the world and mutual funds and portfolio managers and hedge fund managers. They can't accumulate stock without volume increasing. It's impossible, because they're managing billions. They're not managing like you and me, buying a few hundred shares here, a couple thousand shares there. They're looking to buy literally millions of dollars worth of stock. And so you have to have the volume to break out to support that. But you can see the action here has been absolutely awesome on the restaurants. Now, I'm going to take this one step further, because we're looking at a daily chart. When we had Julius de Kempenaar on talking about the RRG charts, he did a really interesting analysis showing that sometimes the daily chart will show a sector or an industry group or a stock moving into the lagging quadrant, while on the weekly chart, it remains very bullish. So you see a little bit of profit taking, which hurts, makes the short-term chart look really bad, while big picture, you still look very bullish. And that is a hallmark of bull markets. You get this rotation, and when things turn against you and against your stock and against your index, it starts to break down. It feels really horrible, because the market's going higher and your stocks are going lower, and you can't figure out why. Well, a lot of times it's just simple rotation. In this case, we had pulled back. Restaurants had a huge move. Restaurants and bars, beginning of 2017, were on fire. And then money rotated. And this is what happens. This is what it looks like. Let's go to the weekly chart on the restaurants and bars. Look at this move in 2017, the first 6 months of the year, 5 months of the year. Look how overbought this group was. Look at how strong the momentum was. When we pulled back on a weekly chart, the big picture, we went right about to that 20-week moving average. We did go a little bit below, so maybe that scares you out. It certainly could. But after sideways consolidating for about 3 months, it broke back out to the upside. And to me, that is an indication that the group is resuming strength. And you can also see the pretty good volume as it was making this move to the upside. And now we're in a very bullish cup. And so when you're looking at the MACD, you also have to take a look at the big picture and what's going on in the stock market. We are in a 9-year bull market. Well, going on 9 years. And it's why, and you can say I have rose-colored glasses, which I do. When I look at the stock market, I look at it as though it's in a bull market and it's going to resolve itself in a bullish manner. Until I start seeing major rotation into defensive areas, negative divergences printing on the weekly charts, that sort of thing. Until I see all of that across key areas, I'm going to continue to look for the market to resolve itself in bullish ways. In this case, the move up came back down. The restaurants and bars became, I think, a very bullish area of the market on this move back to the upside. We've now completed a cup. Maybe we just break out. There's nothing that says we have to go into a handle. But if we were to go into a handle and come back down to this rising 20-week moving average, I think it would be a great entry point into this particular group, based on the fact that we are now seeing, with heavy volume, movement back to the upside and accelerating momentum again on the long-term chart, the weekly big picture chart. So those are some things to think about. Let's keep going. So what are these positive and negative divergences? Well, I pulled up Darden Restaurants. We just looked at the restaurant and bar index. So let's pull up DRI, which is Darden Restaurants, and let's take a look at a few things that have happened on its chart in 2017. First thing that I see is this huge volume. This is a Maribozu candle, which is basically a candlestick where you open on the low, close on the high. Massive volume. If you don't take anything else from this day of trading, you should take away that there was massive accumulation. It opens at a high, it opens at the low, closes at the high. Very solid buying all day long on heavy volume. That's why I love candlesticks. It's really hard to mess up. When you see a candle like this in heavy volume, you've got to be thinking bullish. You got to be thinking bullish. And of course, that preceded continuing move to the upside. That just reeks of accumulation to me. But notice that this also, the top of gap support, whether it be in a couple weeks or whether it be in several months, should offer up some pretty good support. And I'm going to get to that in just a minute. But first, notice at the top here. Now, we had some negative divergences along the way as we made this move up. You can see the MACD never really did anything. But here, as we made a breakout above the prior high, momentum or the volume accelerated. And then as we just went sideways, kind of tailed off, we made that last little move there to the upside. Volume picked up, came back down, essentially hit the 20-day moving average, and took one more final push to the upside. And on this last one here, that is a shooting star candle, which is a reversing candle. One of the things that I get asked all the time is, when do you sell? Well, I can promise you, if I'm in a stock and it's got a negative divergence where it's broken out to a new high and it's got a lower MACD reading and it prints anything like that, a shooting star candle, look at the volume that day, by the way. So everybody wanted in early in the day. So there's really no reason to sell technically. And yet we reversed. And a lot of times that to me is a sign that market makers have moved onto the short side of a stock. And if they're short, I don't want to be long. So in this case, reversing candle, negative divergence, get out. I don't even ask questions. I mean, maybe it keeps going higher, and if it does, that's awesome. And I probably wouldn't have been in this, so I'm assuming this is maybe an earnings report. But whatever it is, I don't like that reversal. And then we went down. Now you're looking at this on the daily chart. And so it's like, okay, where do I get back in? It's been a great stock. I made a lot of money on it. I'm going to get in on this first pullback. Well, not always, if you do, I'm not going to say it's a bad idea, because if you're getting back to the 50-day moving average with a negative divergence, you're resetting the MACD. That's awesome. But keep in mind, you got to keep your stops close. That's the whole idea. Manage your risk. When you get the volume picking up and you start breaking down below the 50-day and prior support levels, that's where you got to say, I'm getting out. And so take your loss. If you get back in on that 50-day test, keep your stop, because now we're moving lower, and look at the MACD now down below the center line. So we have selling momentum accelerating to the downside. Come back up, test the 20, move down one more time. But this time we've got lower prices. We've got higher MACD, and we've got a bullish engulfing candle, which is a very bullish development. And notice that it all happens right in the middle of gap support. So you've got it's technical analysis about using all the tools that work for you and putting them together and trying to find the best trades. Now here you can see this positive divergence. We didn't stop at the 20. We went to the 50. We got that MACD reset at the center line. Started turning lower, but we never took out the bottom. Here's a false breakout. You don't like that candle. Off of an uptrend, you don't want to be in at that point. Take your profits. Here we moved back down, and now we're coming back up and currently trying to test this breakout area on DRI. I think this is a really interesting stock to watch. We got the MACD breaking out, but again, we haven't broken out in terms of price. The other thing I'll mention here is let's go to a weekly chart on DRI, because when we made this last move to the upside, look at that tail to the upside. False breakout, MACD started rolling over. Notice where we went, down to test price support. This is another reason why it's really important to not just look at the daily chart, but to look at the weekly chart. Because again, if I go back to that daily chart, this all looks really bad. We've got the MACD crossing over into negative territory. This looks like a horrible stock, last thing you'd want to own. But you go to the weekly chart, it tells you a completely different picture. This is a stock that had been going up steadily. Heck, it had nearly almost doubled. It's a restaurant stock, and it almost doubled in less than a year. So it's due for a pullback. Look at how overbought it was. Notice when we pull back, the weekly RSI goes in the 40s. We hold price support, and now it looks like we're starting to make this move, this turn back up to the upside. And by the way, we know we have a strong group in terms of the restaurants. They're in a very bullish cup right now. So that's kind of how I use the MACD and all to try to trade the stock market. It's the MACD. It's also the moving averages. It's candles. It's the long-term chart, the short-term chart. It's all of these things put together. It truly is a puzzle, and you're trying to minimize your risk. You're not trying to guarantee a desired result, because good luck with that. I don't know how you ever do that. If you know anybody who can guarantee me results, we'd love to have them on the show and talk to them. I've never met anyone that can do that. But what you do want to do is manage your risk. You don't want to chase these stocks when they're making these big moves to the upside. Yeah, it might work out for a while, but imagine getting into this at, say, $85 or $87, get up to 93, and you think it's the best thing since sliced bread. But then 4 or 5 months later, here you are still sitting down with about a 5% loss. Probably not too happy about that stock at this point. But you get that 50-week test, you test price support. If you happen to get in anywhere near there, you'd be pretty darn happy based on what you see here. And you might say, well, why would you buy here? Well, look at the restaurant and bar index that we talked about. We came right down to that 20-day moving average, and we held for a while, and then we turned, or 20-week moving average. We held for a while, and then we turned back up. So as we're holding and starting to turn back up, it's been very easy to get into a stock in that index. All right, last thing I want to do is just go through a couple of individual stocks that I've traded recently. One, this is an example of where I don't pay attention to the negative divergence. So here you got prices moving higher. This is on Gardner Denver Holdings, GDI. Prices are moving higher, but clearly there's a negative divergence. So why in the heck would you buy this stock? Well, keep in mind, price volume for me is number one. MACD is a secondary indicator. Check out the volume. This was earnings related. Huge gap up, taking out resistance, and it was the heaviest volume that we had seen probably for the last 3, 4, 5 months. Made a beautiful breakout. When it pulled back, here was the entry right on that 20-day, or excuse me, right on the, it was on the 20-day moving average, a hammer printed. And notice that the tail went below the tail with earnings. So from a technical perspective, who in the heck would buy? I mean, if you're taking out that low, I would think that the selling would accelerate. Instead, we reversed. That gives me a sign that market makers have intervened and that they've gone long. And that's when I want to be long. We made this move to the upside. I remember this move back down because I had to try to make a decision what to do, and I had to stop below the tail that day. But that was a secondary offering that GDI had come out with. It held. It went back up. I actually sold. I mean, it's continued going higher, which is great. But when it got up, when I got in, I was looking for a target just above 30 to get close to this high. And I think I ended up getting out like 30.10 or something like that. But I got in around 28. That's pretty nice trade in 10 days, maybe 7 or 8 trading days, probably 10 days on the calendar. I'll take that anytime. But you can see the volume has picked back up again. And notice we didn't go down to the 50-day moving average. We didn't go down the MACD center line. So this negative divergence, you might look at this and say, well, see, technical analysis doesn't work. Well, all this is doing is telling you what price momentum is doing. There's no volume calculation in the MACD. So if you're breaking out on massive volume or you're breaking out on incredibly light volume, the MACD is not going to tell you that. You have to use your eyes and look at other parts of the chart. And here, when you break out and you got heavy volume, increasing volume, that is definitely not a sign of slowing momentum, in my opinion. All right, one final chart, and this is one that is just, it's a more conventional way that I look at the market. And here you can see we made a move up. MACD was very strong. We went sideways. We bounced off the 20-day. We made this huge move. This is earnings related. Look at that volume. Not quite a Maribozu candle, but that's a pretty nice candle. Stock was trading at 106, 107. And the next day after earnings, it hit 125 on this kind of volume. It tells me everybody wants in. Well, if you wait and let it pull back, look at it hit the rising 20-day moving average just as it's approaching the top of gap support. There's your entry. What I'm looking for is just a retest, which I ended up getting. I don't think I got it on that first move back. I think it was actually a few days after that. But on this move back up, I got my target and I got out. And this one, continued moving higher and has come back down and tested the breakout level. But point is, I made my money and it did exactly what I wanted it to do. And if it had failed, the thing is, I've got maybe about $7 or $8, I don't remember if it's maybe $8 or $9 to the upside. But I've got a really tight stop. If it doesn't hold 112.5 or so, I'm going to get out. So I've got maybe $1 risk to the downside, and I've got 8 or 9 to the upside. I mean, I'll take those trades all day long. And I just feel like I have odds in my favor. When I've got a stock that's being heavily accumulated starting at 112.50, why in the heck wouldn't you buy when it gets back down to 112.50? That's where everyone bought before. And I think it was Greg Morris talked to us about it. The market remembers where you buy and where you sell. And that's the beauty of technical analysis. So anyway, that's all I had for the MACD. I know we got the 10 and 10 coming up, and I know that Erin will be getting into her sentiment analysis shortly. So Erin, if you're ready, why don't we go
I
ahead?
am. Hopefully your voice can continue on here for the 10 and 10. That was a great presentation. I hope everybody was, it appears everybody was paying very close attention because the chat room was rather quiet. So
Awesome. I think maybe I put everyone to sleep.
yeah, I don't know about that. I don't think so. I did have a couple questions and we can cover those after our 10 and 10.
Okay.
All right. So the first one we said was going to be Tenet Healthcare, THC.
I didn't cheat. I'm like 50-50 cheating. Yeah, this one actually, and I could have told you this, I could have gone over this as well. This is actually a negative divergence down here. Or excuse me, a positive divergence. And I'll show you. I always use positive divergences in blue. Now you look at it and you say, well, prices didn't go any lower, so it can't be a positive divergence. But remember, it's based on closing prices. So here on this hollow candle, we actually closed way up here. This filled candle, we closed down here, which takes out all these prior lows. So if we connected lows, it would be something like that, because there's the lowest close is that red candle right there. Red filled, that little tiny red filled candle after the hollow candle. But there's your lower prices. And here is your rising MACD. So there's a positive divergence. So the 20-day moving average had been holding as resistance, but once that positive divergence printed and we started moving up, look at this. We actually went through the 20, went up to the 50, but what is that? A shooting star candle or maybe just a high wave candle, a lot of indecision. You can see that there's a long tail both sides, but it gets to the 50-day and now we're back to the reset on the center line. I have to see a breakout on this stock. And so I think it's too early to pull the trigger on this one. I think the key here is to watch this trend line. It looks like we were breaking it. Actually, it looks like we did break it, but we didn't get through the 50-day. I think the next high, if it is accompanied by big volume, would be a buy. Until then, I would be watching, because what we might see is simply on this move down, a little bit of a descending triangle here. And if that breaks down, that would be very bearish. So you've got support down around 12 and a half. And I'm going to say resistance right now at about 14 and a half. And that's your trading range.
All right. Number 2 will be the Oppenheimer Ultra Dividend Revenue ETF, which is RDIV.
All right. I like this one. Big breakout. Always got to be in favor of those. So here's your big move to the upside. Those are nice candles. Great momentum to the upside. Check out this. We just talked about this. Look at the higher prices, black candle at the top, reversing candle, negative divergence, and boom, right back to the 50-day. Here's your MACD reset. And then we're off to the races again. That, in a nutshell, is how negative divergences and slowing momentum works. And beautiful move now, though. Rising 20-day is right at price support. So any kind of a pullback, closer you can get to that level, the better your reward to risk.
Okay. The next one we have is WCN, which is Waste Connections. WCN is in Nancy.
Yeah, some of these waste stocks have been pretty good. This one actually moved up really nice on big volume, but did leave a long tail. And that kind of set this sideways consolidation in motion. I actually really like this stock, even though you got a negative, or not a negative, but you got a MACD here below the center line. And this is another example of how, if you don't lose price support, check this out. All right, so we're still sitting at, look before, when we had all of these closes down here at around 63. See how we broke down on the MACD, had a bearish crossover? Price support was never lost, though. So you had this big move up on volume, sideways consolidation. It looks bad on the MACD, but we held price support and kept moving up. Now you got the same thing. Got this move up, negative divergence. We've come down below the moving averages. MACD's below the center line. Looks horrible. But guess what? We haven't broken down price support. So I think WCN looks good. I would be a buyer.
All right. Next one will be MBUU. And that is, I think, Malibu
Boats.
Yes.
Wow. Well, rising tide lifts all boats, and apparently there's one lifting this boat. Nice move here. It's got a little trend line resistance that it's probably going to deal with. And you can see some days it has very light volume. That might be enough to keep me away from it. I like stocks that are a little bit more liquid. But I would say, you had this area in here. We certainly could draw a trend line, which I think seems to be a pretty, not sure if it's going to connect here or not, but probably close. Let's see if we drag it back right about there. So we got a little bit of a trend line maybe to follow. So any move down below 28, I'd be concerned. And then the upper trend line to maybe keep an eye on here would be right about in here. And that's where we had these tails, couldn't get through. Maybe we could bring that down just a tad. But I would say, your trading range right now, we seem to be squeezing between about $28 and $31. A breakout, I mean, the volume's been heavy on this move to the upside. I find that to be very good. That's 3 white soldiers right there, by the way. A pretty bullish candlestick pattern. So maybe a pullback to the rising 20 and this price, what was price support closer to 29 and a half. If I had to take a guess here, I think this one goes higher.
All right. Let's see. Number 5 will be RIG, RIG. And of course, that's Transocean.
Yeah, it's in a space that certainly has been improving. So I think that's good. Some might look at this and say, what's a head and shoulder top? Well, I would say go back and look at the financial ETF, the XLF, and see how that resolved on that chart. So I don't, again, when I'm bullish the market, I'm not really looking for topping patterns. So I think you can grow premature in your bearish calls when you're in a bull market. So I'd be really careful. I stick to bullish calls. And here we got an uptrend. We pulled back. Look at this negative divergence. So we did go a little bit below the 20, consolidated, didn't quite get back to the center line, but got close. Then we broke out again. And on this latest pullback, volume was light, testing price support. And now look at the volume coming in as we're making this move back to the upside. I think we're going to make another run up for this recent high, about 1160. A breakout above it would be really bullish.
All right. Let's see. Number 6 is going to be CSX. Pretty interesting breakout there.
Yeah, the transports, the railroads have been on fire. Really like this group. This is a long time consolidation that we've been looking at here. So I think this breakout's really important. But you can see just over the course of the last, 7 months or so, a lot of sideways action back and forth. Well, make no mistake on this breakout that there is volume confirming it. So while it has moved up a lot recently, I expect that this this accelerating momentum means that any kind of a pullback to test that rising 20-day moving average is a buy.
Okay. Let's see, the next one is RDS/A. And this would be the Royal Dutch Shell.
Okay. I'm sure
island there, I'd be a little concerned.
Yeah, it's in a nice uptrend. And I look at it more as a cup, and it's just kind of consolidating in a handle. And also, again, I really love the energy space, like the way it's bouncing back, has been bouncing back here. It's actually leading today. So I think what I would be looking for is ultimately a breakout of a cup pattern. So right there is the left side of the cup. There's the right side. And now we're in this right side there of the cup. Volumes picked back up on the right side, by the way, which I think is bullish. And now we're sideways consolidating. I wouldn't be overly concerned here unless I lost the breakout area, which would be down close to 61. Take out the bottom of the cup, take out price support, take out the 50-day moving average. All of that would be bearish. But unless I went down and lost that level, I would remain bullish RDS and I would be long.
Okay. Number 8. Man, we might actually do this in 10 minutes. SSW.
Yeah, I think we're headed for 13 minutes, but
C-SPAN, not the C-SPAN we're used to.
No, this is a completely different C-SPAN. It's not, not doing very well. It's, been moving down, broke a trend line. You can see the MACD here is weak. And so far it's continued failing at the 20-day moving average. So I don't see enough in this stock to consider a long position. I would be more concerned about these failures at the 20-day moving average with the MACD down below center line. So at this point, and volume, by the way, here was much heavier on the selling than what we're seeing on this move back to the upside. So I would be very cautious. The stock, I don't like it.
Okay. Let's see. The next one then is BTE, Baytex Energy, another energy look.
All right, this one looks much better to me. Love the action here. First of all, huge move up. And, again, I don't want to chase. We got very overbought, but notice the pullback as it comes back down went a little further than I would have liked. I would like to have seen it hold that 20-day moving average. So for a couple of days, it went a little bit below, but moving back above the 20-day moving average, I think is very bullish. And there is no mistaking the volume that is coming in on this latest breakout right here above that prior high. Check out the move here and look at the volume the last 2 days. And again, 3 white soldiers. I think this one goes higher to the downside. I mean, it's a small stock. We could see some volatility, but to the downside, I think your entry just below 340 would be one thing I'd look for, and possibly a move down to test that rising 20-day moving average. So those would be the 2 entry points that I'd be most interested in from a reward to risk standpoint. But I like this stock. I would imagine it goes higher.
All right. The last one was a double request, CLMT, which is, let's see, where are we at? Calumet Specialty Products.
All right. This is another one that you might look at and say, oh, head and shoulder. But I think that most of these patterns are going to resolve themselves to the upside. And so I would be bullish this stock. And I'm going to just throw in here a couple of levels. There you can kind of see the support down around 780 or so. Also, higher prices here, lower MACD. And notice the breakout here and look at the volume at the top. Much, much lower than what we saw on these prior moves. So this time, I think the volume is kind of confirming that negative divergence. And then certainly we go down, we hit that 50-day moving average, and MACD got very close to the center line. We took off one more time. Maybe a little bit of a scare here with volume, but we have not lost price support. So I think this one goes higher. I'd be looking for a move back up to test that $9.80 to $10 range.
All right. Let's see. We have, that was our last one. That was number 10, right?
Yep.
Yeah. All right, cool. Not bad.
I'm going to rest and I'm going to let you take over. And you've got the update and you've got the decision, or no, the sentiment. And then we'll come back and give our picks for next week. Right? S&P?
Yes. I'm sorry. I'm getting a little distracted around here. That's okay. So let me go ahead and I'm going to move on here and get to our last market update. My goodness. I was pretty much lost in your presentation. We had a lot of great comments. People loved it. Many saying it's better than a textbook explanation, actually.
Sweet.
All right, so let me get here to our candle glance, see what's been going on while we've been learning about the MACD. All right, we are seeing the market bounce back after the very difficult decline that came in. There was some political news. Tom and I think agree we were chit-chatting, but I'm more of a technical analysis purist. So I always think about everything kind of being baked into the price chart. So I think I agree with you, Tom, that really I like to look at the price action and not get too tangled up in the news noise, as you called it.
Yep.
Definitely agree with you there. All right. So what we can see is, we had that very difficult decline, made the intraday low, but are making a move out and back from that. We've really cleared out a lot of the losses from earlier this morning. And you can see Russell 2000, small caps also coming back to life here. Treasury yields also had a very bad drop, but they are also trying to come back. And we're seeing a reading about 2360. UUP, very roller coaster kind of day, but currently showing a loss and reading at about 2415. And we can see commodities, interesting rounded top, or even a little bit of an atom top, as they call them, V top on commodities. And we're seeing a very similar look on USO. But, we had the gap up on USO. It seems to be holding as support, that gap support. Gold, it was mostly consolidating on news. It actually moved up if the news truly was an issue. But we are seeing now a double top, and it is heading back down. So I'm a bit worried here about gold. If we have this double top, it executes on a neckline here, it would bring us back at least to yesterday's close. And we can see the VIX was rising, but it is coming back down, and we're now at a reading below 13. Declines leading advances. I'm going to take us to look at our scooter movers very quickly so we can see what has been making the big move. So this is the top 10. These are the very strong stocks right now and have been in comparison to their peers and in their intermediate to long-term setups. If you want to learn more about the stock charts technical rank, the scooter, you should go check it out in Chart School. I love using it because you can look at it in terms of where a stock is relatively compared to its quote unquote universe of stocks, but also you can tell how strong it is in the intermediate to longer terms based on its value. So something to consider and check out. RIG, interestingly, we're just talking about that, and it's the biggest scooter mover right now on the charts. SM, we're seeing SM Energy, another nice breakout. We've been talking about energy, and I know Greg's been talking about energy. I just recently got some buy signals on energy, so looking pretty good here. And when I look at SM Energy, we're getting ready to hit this overhead resistance, but this is a double bottom. I would definitely look at that as a double bottom coming off of that consolidation zone and down into it. So with the break of that neckline, I would be looking actually for a move past that resistance level. So looking pretty good there. And that will conclude my final market update. And with that, I am going to go ahead and move into some sentiment. Tom, there were about, I had 2-3 questions that you might want to take a peek at in the chat room and see if you want to answer those, but I might bring those up after I finish this.
Okay. Yeah, go ahead.
Look at sentiment. Oh, and I was looking at, as you were doing your MACD, I know some of the questions sometimes come in as to, what's the difference between the PMO and the MACD, and it is different. The PPO also, everybody says, well, it's isn't that the same as the PMO? And no, the calculations are different. The MACD is that difference between the EMAs. It's unbounded. So you can't really use it as an overbought or oversold indicator. And the PPO is very similar. You really can't use it as overbought or oversold. I think it's more useful in terms of overbought and oversold than the MACD, because there is some of that relative comparisons that you can make with the PPO, but you can't do that with the MACD values. And I think somebody asked in there, should you look at the number or the spacing for the MACD? And I never look at the value of the MACD. But with the PMO, I do, because you can compare those values across the different stocks or even indexes. So that's kind of the difference. I did do a workshop on the PMO. That's where this came from. It's back in the archives. Wow. I'm not sure exactly how far back, but I'm going to bring this one back. We'll do another workshop on the PMO. So anyway, with that, I am going to go ahead and move into our sentiment area here. So give me a second. And get over here. So yes, I was teasing everybody at the beginning of the show. I did see some very interesting sentiment picture numbers here. So I want to show you the put call ratio, because I think this one's really interesting right now, based on these lows that we're currently seeing on all 3 of these put call ratios for CBOE, equity, and the OEX. And so I wanted to, usually the OEX works a little bit opposite, and I like to see, honestly, lows. Here's an example: lows on the CBOE and the equity, and highs on the OEX put call ratios, because typically when you come out of that, you're going to see more of a sideways consolidation. You typically aren't going to see a huge drop. But what we're seeing right now are all 3 of these put call ratios moving lower and looking like they're not going to, well, these don't even look like they're getting ready to turn up yet. So I think that's really interesting as we move lower and lower. When you see these, this means people are bullish because the calls are considered in the denominator. So the more amount of the calls that come through, that's how you understand that the number gets smaller and smaller. So people are getting more and more bullish. And that is usually, with sentiment being contrarian, that tells us to watch out if everybody's very bullish. So I thought this was interesting, and I did mark a bunch of times where we've seen all three of these hitting some lows. Maybe not, OEX hasn't come in that low on some of these, but I think that by looking at this, you can see that there could be a bit of a problem here. I think this bull market is extraordinarily strong, so I'm not overly worried about a huge deep decline. I think we're more, I think the market is ready for a bit of a pullback, but I don't honestly see that until we get closer to the end of the month and into January. But this, I think, is a warning signal that we should be paying attention right now. And although everybody's very bullish, when everybody's very bullish, that can mean that there's problems, because when everybody's bullish, that's when the smart money leaves the market. So this is the AAII chart. And so this is the American Association of Individual Investors. So these are kind of the regular people, the individual investors that are out there doing their own thing. And then they take this poll and say whether they're bullish or bearish. And, I was watching these ratios and they were getting very, very low. They're still low, but we've now gotten back above 1. But what you notice is when we get these really low ratio values, because we have a lot of bears, that typically is when you start looking for the rally to come out. So you can see here, we got that dip. And if you go back up to the third bar, you can see we had just started heading lower. And then that's when we got that very low reading. And so that meant everybody was feeling a bit on the bearish side. And so that means when you get those low readings, start looking for the move up. And this is pretty textbook. We had 3 days of decline. So everybody got very bearish. And then what happened? We've had, 2 weeks of a rise. So I think that does point out the helpfulness of looking at sentiment. So wanted to let you know about that one. I'm sorry, I just lost my audio. Sorry about that. Okay, so I wanted to look at next the NAM, NAAIM name. This is the National Association of Active Money Managers. So that is what we're looking for. I thought this chart was really interesting because look at how the exposure just jumped up this particular move on the weekly chart. So I see that bump. Obviously the active money managers are starting to feel extraordinarily bullish. So they're making that move higher. And I think that's a good move to show that with them feeling so bullish, I kind of trust these guys. They usually are on the right side of the market at first. So seeing them, deep in their exposure, I think that's good, but I don't want to see it start getting really high in conjunction with AAII and seeing the individual investors, getting so bullish. And now we're seeing money managers getting bullish. So we'll be watching to see if that reaches some of these other highs. I'm sorry, I keep coming in and out here. Okay, let's see. The last one I'm going to show you is our RIDEX asset analysis chart. And this is one that we measure who the where the money is going. Okay, we have a group of RIDEX stocks. It's kind of a bounded group, and there are bear funds and there are money market funds, and there are the equity funds. So we track where the assets are going. They report what is in each of those funds. And so what you want to see is where everybody is putting their money or taking their money out of. So in this case, we're looking at bear funds. And in this case over here, we're looking at the money markets, your cash, and then we're looking at those bull sector funds. So what I was looking at is money is coming out of the the money markets, cash. But I find it interesting, we're really not seeing a huge move necessarily into the bear or the bull sector funds. So that's kind of flattening out. So I'm kind of wondering what's going on with that move. But if you make the comparison right here at these lows, and this high for the money markets, and then this low for the bull and bear sectors, you can see after those lows, these started to move up. I'm sorry, these two. So money was coming out of cash and starting to move into these bull and bear funds. But right now, it was kind of a larger dip for cash, money markets to lose compared to the bull and bear funds. But what I'm seeing here is it sort of went split. You had the bear funds, and then you also had those bull funds getting some of that money, but it didn't really flow into one side or the other. So I think that that tells me that things are still looking bullish, but I don't find it extraordinarily bullish as far as sentiment, because we are seeing kind of a split on where the money is going between the bear and the bull funds. You can see that tick up is almost identical. So I think that's telling me that, we need to pay attention. It's getting bullish, but we're not overly bullish when I start looking at, where people are putting their money where their mouth is. We saw those bullish readings on those other charts, especially on the AAII. And so you have, all of this interesting, survey responses that say everybody is bullish. But when we look at the RIDEX assets, this is money where the mouth is. This is where the money is actually going. And so I find this to be a very helpful reading of what's going on just based off of these RIDEX funds. And if you want to learn more about the RIDEX ratio, etc., you will find that in Chart School, and all good. So that is my look at sentiment. And I know we still have about 5-10 minutes. So I'm wondering if you wouldn't mind answering some of those MACD questions.
Actually, I've been going through the chat room and I've been trying to answer them. I think I've gotten all of them answered at this point in the chat room. Are you there?
Yeah, I'm here. Okay. Well, that sounds good. Then that's fine. Were there any? I know we have mailbag questions that come in off and on, and I know that everybody is interested in stops. What do we do with stops? Are they hard stops? Are they mental stops?
Yeah, I tried to address that just in the room a little bit ago too, because someone asked me about stops and whether I use mental or not. And if I'm able to watch the stock market, I use mental. I mean, and sometimes it costs me not having it, because I'll be watching or I just won't be watching for 5 or 10 minutes or something, and I get taken out to the downside. But the price alerts at stock charts would resolve that. I just need to actually start using them. But yeah, I follow mental stops. I know, because I normally don't have a lot of positions. I mean, if I get up to 10 positions at one time, that would be a lot. Normally I have between 5 and 7, and, sometimes even less than that. I think right now I might have maybe 4 out there or something. So it's pretty easy to kind of just go through 4 charts real quick and, continue to watch them. And I have a chart list of current positions that I keep so that I can just quickly refresh on one screen what's going on with those stocks. So I don't really feel the need to have a hard stop. But if I was working all day and I wasn't able to follow my stocks, I definitely would keep stops in place. Sometimes it would save you. Sometimes, it would drive you crazy because you get stopped out right at the bottom. But I think you have to have them, because the one thing that hurts a portfolio more than anything else are big losses. And that's what I try to avoid. And holding stocks into earnings is one way that I try to avoid that. I don't like waking up. I think I showed Autodesk the other day, ADSK. In fact, let me go ahead and pull the screen up and I'll show you.
Excellent.
Let me see here. Oh, sorry, lost something here for a minute. All right, so let me go ahead and pull this chart up of Autodesk. Yeah, I mean, you can see this would kill me as a short-term trader to wake up this was maybe an evening report, but to watch this after hours would I don't know, I'd probably wouldn't be feeling very well after, having a really nice gain over 2.5 months and then watching it all disappear plus some in 5 minutes after the market closes. I just don't like that. So I try to minimize risk. And I think holding into earnings is just one. I know I could hit some that would be going the other way. Sometimes Netflix and Google, they come out and Google goes up 100 points after earnings. And yeah, it would feel great to have those. But for some reason, I just feel like I'm the one that always is on the other side of those. And some of you might be able to relate to that. But I don't know. I don't like taking that risk. So it's great hitting them, but I don't want the risk of losing that much. I tend to maybe have a little larger position than a lot. I think I saw Arthur in his blog talk about that he never puts more than 5%, or maybe I shouldn't say he never does, but it sounded like that's what he was suggesting, was not putting more than 5% into any position. And I'm not going to let Arthur ever take a look at my portfolio.
I know, I have to agree.
Because I don't have any stocks that are 5% of my portfolio. They never are.
Yes.
So he would probably not be happy with me. Yeah. But everybody trades different,
Exactly. And I know for me, because I am more of an intermediate term trader, I do tend to set some hard stops because I'm not going to want to watch it every single day. And I showed you yesterday when we were looking at MGLN, which, by the way, was one of my momentum sleepers that came through, and it's up over 4% the last time I looked. So that turned out good. But when I was looking at, trying to figure out where the best stops were, what I was looking at, I want to eliminate some of the risk just by setting up those stops near support or near an area where I just, for example, looking at this 82, that would probably be close to where I would want my shorter term stop. But as I was telling people, I usually will do it either just a little bit ahead or a little bit lower than that, because I like to have a different number so I don't trigger at the same time as everybody, because it happens to be an even number. So that was where I would set my shorter term stop, but then I might go lower to about an 80 to set a stop on my intermediate term trade, because I don't mind having that much lower stop on an intermediate term trade, but I do move it up as I keep an eye on that chart, every week or so, depending on the horizon for my particular investment. But one of the things I also will consider are setting those limit orders on the top side, so that if it gets to my goal or where my target is, I will sometimes make it set up to sell at that level, just so I can get the emotion out of it. I'm getting to where I was looking for. And in this case, as far as a limit, I had actually said that a bit over, I think I was looking at 89 as a possible short-term limit. But if I'm looking at an intermediate term investment, I plan on holding it a bit longer. Yeah, I would move my limit up to that 92 level. So,
yeah, this was definitely a good one. I know one question. I saw you answered a question earlier, but I'll give everybody the visual. The question was, I guess I was talking about the banks earlier, and the question was, where do I find the components? And I know you were given the written instruction, but I thought I'd just point everybody, because we do this once in a while, but haven't done it in recently. So, first of all, under the sectors, I just hit the summary or sector summary. And if you come down here, banks are in the financial sector. So you go down the financials. And then if you click on banks, it'll bring up all the stocks in this particular index. And the beauty of it is once you get them, here we go. The beauty is you can look at them by percentage. You sort them by percentage. You can sort them by their price. So if you want to look at the small ones, or if you want to look at the large ones, you can sort it there. One of the ways I normally will sort is by scooter, because it'll quickly tell me what some of the best scooter ranks are in this particular area. And then if I'm looking, solely at large cap, maybe I would click on the large cap, and I'm not sure if the large comes up first or the large cap. And then once you've done the scooter, hit the scooter first and then do the large cap. Now, under large cap, I have them all in scooter order, all the large caps. So that could quickly, point out some stocks if you're looking for the big banks. If you're looking for mid-size, and simply scroll down until you get down to the mid caps, and then the mid caps are listed in their scooter order. So there are a lot of different ways to do it, but the Stock Charts does a great job of organizing all this for you. So, because that was one of the early questions that I would always get, Tom, you always write about, or you always talk about an index, but I can't buy the index. So what do I do with those comments? Well, if you like a group, this is how you can get in. If you know the index and which sector it's in, you just scroll down and then you can find the individual stocks. Now, as far as the ETFs go, I'm not really sure. I mean, there are a lot of indexes that have ETFs that track them, and there are a lot that don't. But ProShares, iShares, some of those other companies have a lot of different ETF products. You just have to do some research to find what indexes they track. So with that, I know we're getting close to the end of another week, but we got to give our picks, I guess, for next week, Aaron. So what do you think about the S&P 500? Do you think we're going higher?
Oh, I know this is it's a little tough, of course, given a little bit of what's been going on, but I'm still feeling good about the market through the end of the month. I'm going to be a bull, I think, going into this week. I'm going to look for the S&P 500 to close above 0.25%. It'll be a little bit of a higher week than that.
Wow, this is going to be a tough one. Because I think that interest rates are going to go higher, which is going to take certain parts of the market higher, but I really don't like technology right now. And so I think that's going to kind of hold back every bone in
the S&P 500 we're talking about. So
I know, but it's got all these different factors. Of course, December is the best month of the year for the S&P 500, and today's December 1st. But there's also a period from about the 8th of the month to the 15th. That's next week, the following week, where we want to be careful because that tends to have some profit-taking tendencies. But yeah, I'm rambling because I don't know which way to go.
I'm still going to put you on the spot. You still got to give us one or the other.
I'm not going to pick either. I'm going to go neutral.
All right. Fair enough.
I'm going to go neutral. We've just gone up so much, and I think that there is going to be rotation. I do look for yields to go higher, and I think that'll help certain areas like the financials and industrials. I wouldn't be surprised to see energy continue moving up, but I think it's going to be hard to carry the weight of technology if technology keeps declining and struggling. So I'm going to go with neutral, and we'll see what happens.
All right. Fair enough.
All right. Anything else for today?
I don't think so. I think we're about ready to wrap this whole thing up. Yeah, I think it's really interesting. A lot of people are concerned. We had a big dip, today in the morning, but we are making the move back. So the losses I don't think are going to be that heavy, and to me that speaks to the strength currently in this bull market. It's news is just kind of a blip on the radar ultimately, and we're coming back. So it'll be interesting to see how we finish the day.
Yeah, I can see the Dow Jones already is almost 200 points off of its low. So it looked like it was a really bad day, but now only down 93 points. And after all the points it's gone up, I mean, that really is not much. We are seeing some relative weakness on the NASDAQ, and I wouldn't be surprised to see that continue. Also, a little bit of a relative weakness on the Russell 2000. That's unusual as we get into December. So I would expect that that's not going to continue just based on the fact that the Russell tends to perform extremely well. But we got a lot to talk about coming next week. But for this week, we're going to call it a wrap. I do want to mention Chart Watchers newsletter. First one for December comes out this weekend. So make sure that you are subscribed there. Next Wednesday, Tushar Shande joining the show. He's going to discuss his methods and strategies, talk a little bit about that trend meter. And then next Friday, we announced earlier, Erin will be discussing her DP trend models, which will be very interesting as well. So make sure you have your calendars marked for those items. And of course, we'll go through our regular stuff throughout the week, so you don't want to miss any shows. As far as today's show, I want to thank everybody for stopping by. Definitely fill out that survey if you don't mind as you leave the room. Just let us know what you thought of today's show, the MACD segment, and let us know any improvements that you feel we could use in the show as we go forward. Again, everybody have a great weekend. Enjoy the rest of your afternoon. Be safe, and hopefully see you back here on Monday. Happy trading, everybody.